Hello traders, welcome back to the Forex Gig where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we are going to be talking about the correlation in Forex trading. You will learn what correlation is, how it affects currency pairs, and how to use this knowledge to enhance your trading strategy. So by the end of this video, you would understand how to leverage correlation to managing risks and identifying potential trading opportunities. So stay tuned to gain insights that could improve your Forex trading approach. We start by understanding what correlation is in Forex trading. Correlation in Forex trading refers to the relationship between two currency pairs and how they move in relation to each other. This can be either positive, where the pair moves in the same direction, or negative, where the pairs move in opposite direction. Understanding this concept is crucial because currencies are always traded in pairs, meaning no single pair operates independently. By studying correlation, you can anticipate movement and adjust your portfolio to expose accordingly. Now, currency correlation are measured using a statistical tool called the correlation efficiency. The correlation coefficient, which ranges from -1.0 to +1.0. A value of +1 means the pair moves together 100% of the time, while a value of -1 means that this move in opposite direction. This is basically what it means. However, we should note that correlation are not static. They change over time due to the factors like economic policy, global political events, and market sentiment. You can explain that correlation evolves based on global factors. For instance, diverging central banks policy or changes in commodity price can alter how price pairs correlate or interact with each other. For example, the USD card often has a negative correlation with oil price, meaning when the oil is coming down, the USD card should be going up. Let me change this to US oil. Now, seeing from the chart, you can see when the oil price is coming to the downside, when the oil price is going to the downside, we can see the USD card is basically going to the upside. This signals that they have a negative correlation to each other. While similarly, the AUD/USD tends to have a positive correlation. The AUD/USD has a positive correlation with gold prices. This is another correlation we need to be aware of. And as we can see from this area, that the AUD/USD tends to have a positive correlation with gold. As you can see, it's going to the upside, while the gold pair is also trading to the upside. This signifies there is a positive correlation with the gold pair, between the AUD/USD and the gold pair. This is due to the Australian role as a lead gold producer. Now, short-term correlation may shift due to temporary factors like news events or speculations, while long-term correlation are typically influenced by fundamental economic trends. Monitoring these changes regularly is essential for staying ahead of the forex market. And as you can see, we have positive correlation between the USD, Euro USD, and the GBP USD. They most often or not, they always move in the same direction. And as we can see, price at this stage is moving to the upside. This is the Euro USD, while the GBP USD is still moving to the upside. This is the positive correlation this pair has between each other. Understanding this relationship allows you to better manage your risks and avoid overexposure to correlated positions. For example, holding multiple positions in positive correlated pair could amplify losses during adverse market movement. By grasping the dynamics of currency correlation and how they fluctuate over time, you will be better equipped to make informed trading decisions and optimize your portfolio performance. So let's see how we can use correlation strategy to effectively for forex trading. The correlation strategy involves positively or negatively correlated currency pairs to manage risks and optimize trading position. In this approach, you can open opposing positions in correlated pairs to set po ten tial losses while maintaining composure to exposure to the market opportunities. This method is especially useful when trading pairs that historically can move in opposite direction. This is what it means. For example, the GBP USD and the GBP JPY often exhibit a strong positive correlation moving in the same direction. You can hedge by opening long position on the Euro USD and short on a position on the GBP USD. This is just to hedge. If one position trade incurs a losses, the market due to the market fluctuation, the other is likely to generate gains, balancing overall outcome. This strategy minimize the impact of adverse price movement while keeping your trades active. So if we can see, they basically move in the same direction most often or not. So if you are trying to hedge on this trade, you are basically at this particular time, let's assume on a Monday, the 3rd of March, we decided to take a long on this pair. We took a long on this pair, that's the GBP USD. Then on the 3rd day on GBP JPY, the 3rd, we look for the 3rd, and if we decided to hedge short, remember it is a hedging position, we hedge short on that particular day, we know that one will incur a loss while the other will ride till profit. So if we had taken this trade at this point, we would have still been in profit by now, while if we have taken this, we would have incurred some losses, and we will be sure that because we hedged this position, the other position we took would be riding us straight to profit. To apply this effectively, you start by identifying currency pairs with high correlation coefficients. Tools like correlation metrics and historical data analysis can help you to pinpoint pairs that constantly show positive or negative correlation. So once you identify, you monitor these pairs for changes in their relationship, as correlation can shift due to economic events or central bank policy. Another pair that we can look at is the USD CHF and the Euro USD. These pairs they show negative correlation. So we can see that at this point in time, when the Euro CHF was trading to the downside, as we can see, the last how long is this? The last 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. The last 11 days compared to the last 11 days of the Euro USD, we can see the last 11 days of USD CHF was going to the downside, while the last 11 days of the Euro USD was going to the upside, meaning that they have negative correlation. So it is important to always put this in mind. You have to monitor the pairs for any particular shifts during any news or economic event, so that you know that when they are going through this news, you stay away from the market. So another thing you need to put in mind is when taking this correlation trades, you have to always, it is important that you calculate your position size carefully when using these correlated pairs. For instance, if you are using the Euro USD, and the USD chair, because they have near perfect negative correlation, you might adjust your loss size. You might have to adjust your loss size based on their pip value to ensure balanced exposure. Remember, each of these pair has different pip value, so you have to always adjust your lot size based on their pip value. This will prevent one trade from and the other overwhelming the other due to the differences in their volatility or their pip value, meaning from here to here might be 100 pips, while from here to here might be 200 pips based on their volatility. This is basically what I'm trying to explain. By strategically pairing correlated currencies, you can reduce risks without completely sacrificing market exposure. Now let me explain why they have why their volatility are different. I'll quickly measure the distance, their peak values, to explain better to you guys. So let's see, this is a peak value. We are going for a distance of, this is the particular distance we are going to, and this is an approximate of 414 pips. So I will copy this and I will put it in my other charts of my USD chair to show the difference in their pip value. Pasting this over here. This was not able to paste. Copy. This is to copy it, put it in this area. Okay, we can see at this particular area, we can see that this is a reduced, the same distance is giving us a total of 333 pips, showing that the Euro USD is more volatile compared to the USD chair. This is basically what I was trying to explain. So this approach requires constant monitoring of correlation and adapting positions as relationship evolves over time. So you have to keep this in mind, that one pair has a different volatility compared to the other pair. So when trading correlation, we have to be wise about the whole trade setup and put to mind about the news or upcoming economic events that could affect our trade setup. So this is all for this. This is all for this trading strategy on how to use correlation in forex trading. So alright traders, we have come to the end of this video. You have to engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like, subscribe and turn on your notification bell so that you will never miss out on more trading tips and strategies. Thank you for watching, and I will see you in the next video.